Welcome to the short executive knowledge lecture on Topic 2, Paper 2 of the SFC licensing exams. This topic will cover requirements of relevant subsidiary legislation and looks at the rules that have been written by the SFC and passed by the Hong Kong government as subsidiary legislation. I will emphasize the important points to help you understand the core material you need to know to sit the exams, and you can download a copy of these study notes from the Executive Knowledge website under Paper 2 Resources. Now, I strongly recommend that you supplement these lectures with question practice, and our questions can be found on the Examinator.online platform, and just select Paper 2. Now, what is in Topic 2? Well, as I said, it's the subsidiary legislation. We'll be looking at the financial resource rules, client security rules, and client money rules, and those are really the upfront main ones. We have others: the contract note, statement of account and receipt rules, the keeping of record rules, accounts and audit rules, and then one section, extremely important, compensation and insurance rules. Not so much the insurance, but the compensation, the investor compensation fund, that we will cover in section 7. Now, a relatively new set of rules, the contract limits and reportable position rules. We will touch on those. And then we have two sets of rules with regard to OTC derivative transactions. Now, this came out of the debacle of 2008 when over-the-counter derivative transactions, the credit default swaps, interest rate swaps, etc., nobody knew where they were because they're not exchange traded. So these two sets of rules, one on reporting and one on mandatory clearing, have been introduced, and we need to be aware of them. Although if they were to be examined, it would be one question maximum. And then some enforcement actions that we'll make reference to without having to know them in detail. Okay, what about the financial resources rules? The SFC has two main levers to control the systemic strength of the Hong Kong markets. One is financial resource rules, and the other is the statutory audit. Well, here we're looking at the financial resources, financial resource requirements. Now, the first requirement we'll look at under 1.1 is the requirement for paid up share capital. Do I need to know these numbers? It will do you no harm. Not every exam examines the numbers, but I have seen a question where they asked you the difference between dealing in securities and securities margin financing in terms of paid up share capital, because what you will see in the table on page 4 is that the main requirement is 5 million Hong Kong dollars share capital if you are dealing in securities or advising in securities where you hold client assets. If, however, you go beyond that and you are providing securities margin financing, the minimum paid up share capital requirement is 10 million. Now, they only look at the highest amount required. So if you are involved in dealing in securities and securities margin financing, you do not require a minimum of 15 million. It's the highest, which is 10 million. We then come on to liquid capital requirements. And at the top, page 5, you will see the formula, if you can refer to it as such a thing. Liquid capital is liquid assets minus ranking liabilities, and the liquid capital must be greater than the required liquid capital at all times. What is the required liquid capital? There it is in the table following. And for dealers, minimum, the required liquid capital is 3 million Hong Kong dollars. Now, there is a couple of variations on that. One is if you're an advisor and you do not hold client assets, your required liquid capital is 100,000 Hong Kong, and not referred to here, but if you're an approved introducing agent, which we touched on earlier, then your minimum is 500,000. Now, you've got to draw up your balance sheet to show your liquid capital requirements, and the balance sheet has to be drawn up on specified bases, and there they are at the bottom of page 5, in accordance with generally accepted accounting principles, etc. Now, that never ever used to be examined, but recently we have seen a question pop up, so I wouldn't ignore it altogether. We then have an outline of what we consider liquid assets to be and what we consider ranking liabilities to be under 1.2 and 1.3. I'd be aware generally it's highly unlikely that you're going to find questions testing you in the details of the criteria. Reporting requirements. If you hold client assets, you must report on a monthly basis. If you do not hold client assets, you're an advisor, you have to comply with the financial resource rules, then it's every 6 months you must send in your return. And under 6 monthly returns, they outline what you must provide, liquid capital computation, etc. I would be aware of those 4 points. Now, you must notify, under the financial resource rules, you must notify the SFC in writing if, and here it goes, liquid capital falls below 120% the required liquid capital. Now that is a buffer. If, however, second point, your liquid capital falls below the required liquid capital, then you must cease trading and inform the SFC. If the SFC considers it okay to continue trading, then you will be allowed to. But that's the important one. That's the trigger. If your liquid capital falls below the required liquid capital, you must inform the SFC and cease trading. And then there are other requirements for notifications listed there. Now, the client securities rules on page 8 are designed to protect client securities that are held by intermediaries on behalf of the clients. Now, what do I need to know? Well, what are the securities that these rules apply to? Second bullet point under section 2 says the rules apply to client securities or collateral of an intermediary that are listed on a recognized stock market. Now, when they say recognized stock market, they are talking about the Hong Kong Stock Exchange. Interests in an SFC authorized collective investment scheme and received or held in Hong Kong by an intermediary in the course conducting a regulated activity. 2 or 3 things to pick up from this. It is the securities that are highly liquid. So those that are listed on Hong Kong's stock exchange and those that are authorized collective investment schemes. Now, collective investment scheme is a mutual fund, a unit trust, but to be authorized, or rather, if they are made available to the Hong Kong investing public, they must be authorized by the SFC. What is not there is unauthorized collective investment schemes. Now, an unauthorized collective investment scheme is like a private equity fund that is made available to professional investors, not to the investing public. Those investments are not covered by these rules. I'm emphasizing that because that was the answer to a question previously. The other area that's often examined, both with regard to client securities rules and client money rules, is that the rules only apply to securities and money that is held in Hong Kong. If the securities or money is held outside Hong Kong, the rules do not apply. Also, the following bullet point tells us the rules, client securities rules, do not apply to securities that are held in an account in a client's name because there is no risk. The risk is when they're held in an account that's not the client's, the risk being that they would be liquidated, and that is why this is heavily regulated. Now, the major regulatory point of the client securities rules is that client securities should be held in separate segregated accounts. So, second bullet point under section 2.1, assets should be kept in safe custody in separate segregated accounts for each category, that is securities and collateral. Please be aware of that. That is the whole reason for having the client securities rules. Client authority, they can pick up on this. This is a standing authority where the client authorizes the intermediary to deal with the securities the intermediary holds in ways specified. Now, the sort of second sub-bullet point under 2.2, and then the next second bullet point says the effective period specified in the authority cannot exceed 12 months, but it may be renewed on the written request of the client, or it may be a deemed renewal where the intermediary writes the client giving 14 days notice that if the client does not get in touch, the authority will be automatically renewed. And that's known, as I say, a deemed renewal. And the last bullet point under the standing authority section is that there's no time limit for renewal for professional investors. You still have to have the standing authority, but it can run in perpetuity, does not have to be renewed. There are some details under 2.3 with regard to the handling of the client securities and securities collateral, and be aware of those. Now, what is going to be examined under client securities rules? Well, it's going to be the securities that are covered. It's going to be the fact that the securities must be held in Hong Kong for the rules to apply. It's going to be that the securities must be held in a segregated account, and you should be aware of the standing authority that gives the intermediary the right to deal with the securities that are held on behalf of the client in ways specified. Now we have the client money rules, and these are similar to the client securities rules in that they're protecting client money that's held by the intermediary. And again, it is a client money that's held in Hong Kong, and it's not money that's held in a client's own bank account. Once again, the money must be held in a segregated account, and I can't emphasize that enough. So the financial resource rules, the client securities rules, the client money rules, I would suggest central to paper 2, and I certainly would be aware of those.